the things that we do is our third strategy is we ride the yield curve. We manage where we are on the yield curve. I want to talk about another strategy now for bonds, and that's what's called a bond ladder. And this is a hypothetical bond ladder where we take our money and we divide it into 10 pieces, and we put 10% of the money in each year for the first 10 years. Then each year, as the 1-year bond, the short-term bond matures, we take that and we buy a new 10-year bond, and that 10-year bond became a 9, and the 9 became an 8, and a 7, like that, and it just moves like that in a circle. After a while, what we have is a bond portfolio, if we have a normal yield curve, that earns a 10-year yield where a 10-year bond would be. We get that kind of yield on the yield curve, but their average maturity is 5 years because half the bonds are going to mature in the next 5 years. So we end up with the risk of a 5-year bond with the yield of a 10-year bond. So that's one of the reasons we add bond ladders it's the fourth part of our strategy on how we manage bonds. The first one, again, manage maturity. Second one, look at manage the credit worthiness. Number third is look at the shape of the yield curve and ride it where you get the best bang for your buck. And the third one is to use a bond ladder to get a higher yield for the amount of risk you take. And then finally, the thing that I want to mention is diversification. So you don't just buy one kind of bond. So in the U.S. market, you have U.S. bonds, agency bonds, state and local government bonds, as well as corporates. We also have the same thing in foreign bonds, non-U.S. bonds, and as you should know, in all of our portfolios, our bonds are mixed into both foreign bonds and U.S. bonds. So basically, we have 5 strategies for managing the bonds in a rising interest rate. We can play with the maturities. We can play with the coupon rates or the credit of the issuers. We can look at what the yield curve is and try to optimize where we are in the yield curve. And we use bond ladders and we diversify. So this call is for clients, so you have your portfolios with us. So just as an example, in your portfolio, you should have a Thornburg limited term income fund. So it's a fairly short maturity, and it's a bond ladder. Thornburg does bond ladders. You'll also have probably a DFA a bond fund. That one does the first 3 things: rides the yield curve, manages coupons and maturities. You also have an American funds bond fund, and again, they're managing the first 3 parts. We also have the international fund, and that's where the diversification thing's in. So that's how we're dealing with the risk of higher interest rates. Now, let's just talk just real briefly what happens if the stock market goes down. And the last couple of weeks, there's been a fair amount of that. Although earlier today we were up 140 or something like that. But overall, we're down for the last couple of weeks. Well, first thing to note is that even with this adjustment, the U.S. stock market is up somewhere in the neighborhood of 10% or so for the year. So it's not altogether bad. But the other thing is that in every market, there are what we call corrections. That is, the market went down during a bull market. And this is a list of all the 10% corrections where the market dropped 10% from its high point before it turned around again, or more, since 1962. The last one was in 2009. The bull market had gone up 79% over 410 days. We had a 10% correction where the market went down 12%, and that lasted 27 days. That's the bottom line there. But you can see that in every bull market, if you look at them, what the averages are, you look at the percent change, it says the averages are down 12.3. But if you look at it, that's pretty average. If you look at the length, well, it says the average is 126 days. The range is very broad. from the high to the low. You can see from a low of 27 days to a high of 288 days. So when it goes down, we don't know how long this is going to last. But the fundamental economics are there. So we're not going to freak out and be worried or anything if the market goes down a little bit. The fundamentals of the U.S. economy are continuing to improve. So what do we do? How do we react to this? Well, you remember that we do this little thing called rebalancing. You get our emails from us every now and then that say we rebalance. So putting it very simply, if we start with a 60% in stocks and 60% in bonds, or you hear us use the term 60% in equities or 60% in fixed income, that drifts over time. And when it drifts a certain amount, then we sell the one that's high and buy the one that's low in terms of a percent of the portfolio, not in terms of their absolute performance. So we say you can let your portfolio drift with the prevailing currents, or you can try to steer a steady course. What the benefits of rebalancing are, it can improve returns because it forces you to sell high and buy low. And I think that's the number one reason that it makes good sense. And secondly, it reduces risk and volatility because the more volatile assets tend to grow in size relative to the portfolio and be sold into the less volatile assets on a regular basis. So that's it real quick. My part didn't take as long as theirs. They normally we do about 30, but they were about 35 minutes, and mine's only taken about 20 minutes. Just a brief overview of how the bond market works and our strategies for dealing with rising interest rates. We have been preparing for rising interest rates for about 4 or 5 years now. We don't see any crisis on our hands, but again, those of you who know us, we don't do crystal ball work, but it doesn't take a rocket science to figure out if interest rates are at less than 1%, they don't have anywhere to go but up at some point. And so we have been doing our study and our research as we do in all parts of our investment portfolio work, and these are the 5 strategies that we're using to monitor and manage the fixed income portfolio.